Well, now we have with us Brad Brain. Brad Brain, BA, CFP, RFP, FMA, CHFC, CLU, and CHS. There's no more. Is president of Brad Brain Financial Planning, Inc. in Fort St. John, British Columbia. He had to scramble to get here because Air Canada had a problem flying planes, apparently, from Fort St. John yesterday. Of course, their motto continues, "We're not happy until you're not happy." But Brad was able to hijack something and get himself here. Brad helped write the Certified Financial Planner exam for CFP candidates. He has been an MDRT member since 2010 with 2 core-to-the-table qualifications. He is a member of the Insurance Council of British Columbia and a long-serving member of Provincial Advocacy Committee for British Columbia. He's a member of CALU and serves on the Sponsorship Committee for the Institute of Advanced Financial Planners. Please help me welcome, all the way from Fort St. John, BC, the hard way, Mr. Brad Brain. Brad.
Thanks, Dave. What I have is a strong protective instinct to keep my clients safe from harm. A young lady that I mentor told me that. I want to make sure that my clients never have to worry about running out of money in retirement. I want to make sure that when my client is dealing with chemotherapy, he's got the financial resources that he doesn't have to worry about how he's going to fix his leaky roof. I want to make sure that when my 40-year-old client with 2 teenage daughters has to take a month off work to provide palliative care to his dying wife, that he can do that. I have a strong protective instinct to keep my clients safe from harm. So, as Jim mentioned, I'm from a small town in northern BC, and I'm an investment guy. As Jamie was speaking here, I was thinking back on my own career, and if somebody had told me back when I started that I'd be one day standing on a stage in Toronto, sharing it with this elite group of people at an insurance conference, I would think as a cautionary tale, like, why me? I'm the investment guy. I do a lot of retirement income planning, and one of the things that is obvious when you're in the retirement income field, the client's number one fear for people hitting retirement is, am I going to be okay? So you're sitting across from people, and they're worried, am I going to run out of money? Am I going to be okay? And they're looking to you for answers. And I love it when I can say to them, if you do what I say, and you follow this plan, you are guaranteed to never run out of cash, regardless of longevity and regardless of how cruel the markets might be to you in retirement. That's a beautiful thing to say. And why I can say that is because I use a lot of guaranteed minimum withdrawal benefit products. But I'm not going to say that phrase outside of this room. But I will tell you, though, that this stuff really works. This really, really works. A few months ago, I had a fellow walk in, and what he said is, I'd like you to look after this money for me. Now, why I share this story isn't purely because of the size of the account, but think about that. I've never met this guy. I don't know who he is, but he knows who I am. He's a walk-in, and he wants to give me $800,000. Because although I don't know him, he knows me, and he knows my friend George, who's a client. George has told him about what I'm going to show you guys today. It's an unsolicited client referral for $800,000 because of guaranteed minimum withdrawal product. But again, I don't say guaranteed minimum withdrawal because nobody outside this room talks like that. I have no idea who coined the phrase guaranteed minimum withdrawal benefit. I think that if you were to talk to people like that outside of this room, you run the risk of this. I clipped this from an industry publication 20 years ago, and I keep it with me to remind me that clients don't speak like that. So I don't say guaranteed minimum withdrawal benefit. I call it the guaranteed income strategy. And I'm going to run through real quick with you. But normally, what I do with this is I do it pen and paper. I'm going to try to do it a PowerPoint. If it turns out that you've got some questions, I'm absolutely happy to talk to you about this. Grab me anytime through the day. Stay in touch electronically with me. I'm happy to elaborate. So here's what I do. Before I get into a sales presentation, we talk about actual numbers and the person's actual situation. I'm going to set the stage. I'm going to set the stage for them. And what I'm going to do is I'm going to say, okay, if it's 2015 now, and we want to retire, let's say it's at age 65, well, we've got two stages now. We've got an accumulation phase, and we've got a withdrawal phase. And basically what we want to do is make as much money as we can during this accumulation phase so we can spend as much money as we want in the withdrawal phase. So we've got a couple of layers to the guaranteed minimum income product. One of them is going to be the market value, and one of them is going to be the guaranteed value. And when I do this presentation, I do color code it. I'll use a blue pen and a pink pen or some other color. So it's clear to them that they can see the difference between what the market value is and what the guaranteed values are. So when we look at growing our money here, we're hoping for good returns, obviously. But the thing about that is that if we're trying for good returns, we're going to get an entire range of possible results. So we're hoping for good returns, but what happens if we get mediocre returns? What happens if we get disappointing returns? And so far, I haven't spoken about anything specific to this product. This is anything. It could be mutual funds. It could be rental real estate. It doesn't matter. We're trying to make as much money now so we can spend it later. But this is where we're going to introduce this innovative aspect about the guaranteed income strategy. And that is, regardless of what markets do, the money that you put in now, which is going to form the income base for your future retirement income, is going to grow by at least 5% in every year between now and when you eventually take the money out. Now, 5% on its own, that would be fine, but 5% is not the best case scenario. It's the worst case scenario. Because if we do happen to have good returns, that top red line, what's going to happen is every 3 years, the insurance company is going to compare your guaranteed value to the market value. And if the market value happens to be higher, it's going to reset your guarantees up to the higher amount. And now our 5% continues on after there. Now, one of the cool things that sometimes people overlook is this market value adjustment. That happens in retirement too. We can see our income base bumped up even after we start taking the money out. If we don't get those good returns though, if we get something other than 5%, you're going to see this minimum 5% bump to your income base happen every single year that you don't take money out of the product. And then when you do start taking money, you're looking at guaranteed income for the rest of your lifetime, regardless of longevity and regardless of how bad the markets might be. So basically now, our range of possible outcomes is now between the two blue lines. That's it. We've eliminated these mediocre or disappointing returns. That's not part of our lexicon anymore. And that's our new possible range of outcomes. And if I was to ask a client at this point, how does that sound? Who's going to not want to make sure that they finish somewhere between the two blue lines and, whoops, went too far, and take these mediocre or disappointing returns out of the equation completely? And at this point, this is where I'll start showing them some numbers about their own situation. So there's a few different applications for this. This is a product that's designed to produce lifetime income, so clearly retirement situation, RSP to a RIF is that's probably where you're going to do most of the work. And one of the things that I think is the probably least appreciated aspect about this is if you have a situation where the legislated RIF minimum is higher than your guaranteed minimum, the insurance company is going to pay you the higher RIF minimum, and you still have all your guaranteed lifetime income guarantees fully intact. Now, there's been some changes to RIF minimums, there's been some change to these products, but this is still of value. I'll give you an example. Let's say that your guaranteed lifetime income is $25,000, but you've got enough money in your RIF that the legislated minimum that you have to take out is $27,000. Well, you're going to get the $27,000, and you still have that $25,000 lifetime income guarantee. That's a beautiful aspect of this product that I don't know that gets enough attention. There's other aspects too, though. Let's say a tax-free savings account. What's a tax-free savings account? Well, you put your money in, you're going to get tax-sheltered growth, and then you're going to be able to take the money out without paying any tax. We'll pair that up with guaranteed income strategy. tax-free withdrawals, guaranteed income, put them together. Now we're looking at tax-free income for your life. Another way that I'll use this is as a substitute for fixed income. Okay, I'm the investment guy. I have a really hard time getting excited about fixed income products. I think at best you're going to get mediocre returns, and at worst interest rates go up and you get a 1 or 2 year setback on your bonds. And why people would put maybe 40% of your portfolio in something that has such a pessimistic outcome, it bewilders me. But let's say for sake of discussion that maybe on a fixed income portfolio you can get, I don't know, let's say 2, 3%. Well, 5% is a bigger number than 2%, right? Let's use guaranteed minimum income as your fixed income substitute. Okay, so now, oh, I'm going the wrong way. That last idea, that took me to quarter table. I think this one's going to take me to top of the table. This isn't a presentation per se, though, just some things that I'm going to be talking to people about when we look at estate planning. And the situation I have up here now, what we have, this is a real client. It's not all their money. It's not even all the money they have with me, but right now we're looking at basically 1.9 million that I'm going to use for this analysis. Part of that money is in an RSP at this point. Part of it's non-registered. So, of course, on the death of the second spouse, the registered money is going to be fully taxable. Going to pay capital gains tax on the non-registered stuff. Here's the thing, though. This is a problem that right now is only going to get bigger over time. And if they were to pass away in 25 years, factoring in what they're going to spend between now and then, we're looking at roughly a $900,000 tax bill on this part of their finances. So, and in speaking with them, I'm going to mention a few things about it. One of the things is, and I'm pitching a $50,000 whole life policy to them. Now, there's some people here that do work with, it's not in my stratosphere. There's some people here who a $50,000 whole life policy would be maybe even under their radar. That's not me. This is the stuff that I'll take that all day. But it's a lot of money, right? It's a lot of money to the client, too. They're thinking, how can I possibly pay $50,000 a year for an insurance policy? But the thing about it is they're thinking about what it costs. They're not thinking about what it does. Because the problem isn't the $50,000 that this thing is going to require to be funded each year. The problem is the $1 million that they're going to have to pay, either they're paying it or their estate's paying it, to the government on the death of the second spouse. So $50,000, this is actually the affordable option. I'm also going to talk about the dividend history. I've got a separate slide on that, so I'll save that for a minute. And okay, I'm the investment guy again. I'm going to talk about the whole life policy as an asset in itself. And I think I'll elaborate on that on the next slide as well. In particular, the company that I'm using here is Equitable, and it's possible that Equitable might demutualize. And if that's the case, this guy might get a future windfall on the demutualization. And then the other thing I'm going to talk to him about is that this is a policy that we can get placed. We're going to be able to deal with an underwriting department that wants to work with us. So let's talk about the dividends. This is what a number of insurance companies have paid out on their participating policies over the last 15 years. That's a really nice table to be able to show people. If you were to stack that up against the TSX or some other option for their money, or GICs, this looks great. It looks great not just because the numbers that they're paying are attractive, but also how consistent they are. Right? If I'm the investment guy. A lot of my clients, geez, in 2008, we were fully exposed to that. We had people that had $1 million turned into $600,000. So if I can show them something where they're going to get a 15-year track record with very little variance in returns at that very solid rate of return, and let's think about how this is taxed. If we're looking at a whole life policy, we don't have to pay tax on the growth. When we're eventually going to use this as a death benefit that's going to flow to the clients free, the beneficiaries free of tax and free of probate, compare that to a fully taxable GIC. Right? So let's say the clients don't buy this insurance policy, they just leave their money in the bank account. They're never going to spend it. They're going to eventually give it to the kids. So if the money's just sitting in a GIC, fully taxed, and here we're going to be able to improve the efficiency on it. I see I got to speed up considerably here, so I better keep going. And I'm also going to pitch their how they could pay for this tax bill. They could sell stuff, they could borrow, they could start saving now, assuming they don't die too early, or they could use life insurance, and life insurance is the most affordable option. Okay, sorry about this, I'm going to have to really hit the gas. Critical illness, but with return of premium. So we saw some numbers before. Corey's presentation, I think, had this, where what's the risk of people having something bad happen to them? Well, you can show this to people, but they don't necessarily buy. So what I do is I tell my own story. I was considering a $100,000 critical illness policy, but I already owned all the disability insurance I could qualify for. And I was stumbling about whether I could buy more coverage. And what finally convinced me, and actually the illuminating thought there was I would be an idiot not to have it, is with return of premium, I get all my money back. So now, if I get sick, I have the policy. If I don't get sick, I get all my money back. And when I realized that, when it finally dawned on me I could do that, then what I did is I bought $250,000 of coverage on myself, not $100,000. So for those people that don't think it'll ever happen to them, return of premium might be the thing that finally gets them off the fence. Okay, so I've told you a little bit about what I do. This is why I do it. These are my beautiful kids. Emily, who's 8, William, who's 6, first day of school. Us going mud bogging. Emily on her horse. Emily at soccer. This was a fun story, but I'll have to speak about that later. William riding his bike, no training wheels. Emily at piano recital, sledding. Another fun story. William at Beavers. Emily and her bunny rabbit. William winning the Stanley Cup. And this is a good one. This is Disney Vacation last year. California Screaming. It's the biggest roller coaster in the park. It goes to 0 to 100 in 4 seconds. It's got an inverted 360-degree loop on it. Look at the guys in the back. Look how much fun they're having. And meantime, my daughter's giving 2 thumbs up. I just love that picture. So here's the thing. What if something happened to those kids? What would happen to me if something happened to those kids? I'd be eviscerated. I would not be able to function. I would definitely not be here talking to you guys. I would not be in the office. My income would cease. So I have insurance on my children, not because I'm trying to protect their income, but because I'm trying to protect mine. I see this as being a very underserved market for life insurance and for CI. I don't care if it's a rider or a standalone policy. All of your clients who are parents or grandparents have a Facebook account that looks just like mine. Let's talk to them about insurance for their kids. And finally, I'm going to wrap up with, well, this is a policy on Emily, but I'm going to have to skip through these slides. Wrap up with this one here. All the problems are prospecting problems. This is a very liberating thought, because what that means is that's fully in your control. You don't have good clients, go get better ones. Your career is completely in your control. So one of the things that I learned when I first started in the industry is to track what you do. And it worked so well, I stopped doing it. I'm doing it again. I don't worry about all the things I do. The only thing I do now is I track my outgoing calls each day. And I can assure you that if you make a habit of that, it's going to translate into better success. Thanks for your time. It's been my genuine pleasure. Good luck and good selling.
Okay, there you have it, the definitive message. This time, using investment perspectives to sell life insurance. Brad, I was astonished by how you were able to bring that thing in for a landing. Awesome discussion. Interesting when you can look at insurance from that as an investment and what it can do for families. Extraordinary. Some great ideas in there from the never run out of money guy with that guaranteed income stream. Great line also, I think, this idea that sometimes you really can't use the words you hear from the marketing department. I don't know who invented GWMB, temp, whatever. I get completely lost with that, but nobody really understands that. You need to speak in their language. Clearly, Brad, you do, and that's why you do the job as well as you do. You know, clients really need your help. So we got some great ideas about life and CI sales ideas here from a money guy, and very important. One last thing about that, I thought very cool. Everybody has a Facebook account, and you see how important, you know, it's interesting. Their lives are so important. It's my grandchildren, what my kids did, and what happened here, what we did last Tuesday. Well, do you want to maintain your Facebook account once you're gone? Or would you like your kids to have that much fun still? It's an interesting thought. Interesting material, absolutely. Thank you once again, Mr. Brad Brain. Thank you.